Okay, today we are diving deep into a massive, but kind of hidden part of our financial system. We're talking about a multi-trillion-dollar world that operates in the shadows, a world people often call shadow banking. And it's quietly become one of the most powerful forces in the global economy. You might actually be more connected to it than you even realize.
This quote, yeah, it really gets right to the point. A hidden, multi-trillion-dollar risk. I mean, this sector has grown into an absolute giant, funding everything from brands you know and love to small businesses right in your own town. So what exactly is it, and why are so many experts suddenly sounding the alarm?
Right, so who are these guys? How did they get so powerful while operating outside the regular, regulated banking system we all know? Well, to figure that out, we need to meet the new lenders on the block. The answer is a sector called private credit. And you can forget about your typical high street banks. No, these are a whole new breed of lender, and believe me, they have completely reshaped how businesses get money all across the globe. So here's the fundamental difference. Private credit funds, they act a lot like banks, but they are not regulated like them. They take these huge pools of money from big investors, think about pension funds or massive university endowments, and they lend it directly to companies in these private deals, totally bypassing the stock market. Now, to really get your head around how private credit got this big, we actually have to go all the way back to the last major financial meltdown. Its roots are directly tied to the chaos that followed the 2008 global financial crisis. You can see the whole chain of events right here. The 2008 crisis leads to these really tough new banking rules like Basel III. And that made the big banks a lot safer for sure, but it also forced them to pull back from certain types of lending. Well, that retreat created this huge funding gap, and you guessed it, private credit just rushed right in to fill that void. Honestly, it was a perfect storm of factors. On one side, you had new regulations pushing traditional banks out of the picture for certain loans. On the other side, you had investors, and this includes the pension funds that manage retirement savings for millions of people, desperately looking for better returns because interest rates were so low. And at the exact same time, the private equity industry was booming and needed massive, fast loans for company buyouts. It was just the perfect recipe for explosive growth. So we know why it grew, but how does this world actually work day to day? Because it is built on a completely different model from the traditional banking system that we're all used to. And this comparison is absolutely key. You see, banks are heavily regulated. They're transparent. Private credit, it's largely opaque and has very little oversight. Banks use our short-term deposits to make loans. These funds use long-term money from institutions. And that difference lets them move way faster and offer these really customized deals. They're basically playing in the same sandbox as banks, but by a whole different set of rules. It's a classic case of what they call regulatory arbitrage. And the players here? Oh, they're some of the biggest names in finance. Blackstone, Apollo, KKR. They manage these enormous funds, all fueled by cash from pension funds and sovereign wealth funds. And their strategies vary. The most common one is direct lending to companies, but they also get into much riskier areas like mezzanine finance, which is kind of like a hybrid of debt and equity, and distressed debt, which basically means buying up the loans of struggling companies, often for pennies on the dollar. Okay, so this brings us to the core debate. Is this whole thing a brilliant financial innovation that's just fueling our economy? Or is it a disaster waiting to happen? Because there are two very, very different sides to this story. On the one hand, the benefits are pretty clear. I mean, private credit provides absolutely vital funding to all those middle market companies. They're the backbone of the economy that banks might now just ignore. This fuels growth, it creates jobs. And for investors, it offers some pretty great returns. Plus, for the financial system as a whole, it means we're not just relying on a handful of giant banks for all our credit. But let's be real, the term shadow bank exists for a reason. When you have this much growth and this much risk-taking happening outside of public view, outside of traditional regulation, well, that's when some really serious concerns start to pop up. And here they are, the major concerns. The lack of transparency creates blind spots for everybody, including the regulators. These funds are acting like banks without any of the bank-like safety rules. They're also deeply interconnected with the traditional banking system, which creates a huge risk of contagion if things go south. And on top of all that, there are real questions about the quality of the loans themselves, many of which offer very few protections for the lender. It's a combination that, well, it sounds worryingly familiar, doesn't it? And just to put this into perspective, this market is already worth well over $1.5 trillion, and it is expanding at a breathtaking pace. That sheer scale, combined with all the risks we just talked about, the opacity, the interconnection, that's what has regulators so worried. So where does all this lead? Well, the system that grew up in an era of super cheap money is now facing its first real test in a completely different economic world. And this is the crucial test. See, for over a decade, borrowing was cheap. It was easy. But now, higher interest rates are putting immense pressure on those highly indebted companies that private credit funds loaned all that money to. We are literally about to find out just how resilient this system really is. Regulators are facing an incredibly difficult challenge here. They need to get a handle on the risks, but they're often operating completely in the dark because of these major data gaps. The big question is, how do you introduce oversight that protects the financial system without completely choking off the innovation and capital that our economy now heavily relies on? So we end right where we began, with this one fundamental question. Is this the efficient, innovative future of finance, a better way to get money to growing businesses? Or by operating in the shadows, has it sown the seeds of the next systemic crisis? The answer to that is going to define the financial landscape for years to come.